According to new and frankly shocking results, Americans have lost all hope in their economic futures. Where it comes to specifically incomes, the numbers are just staggering, unprecedented. And when does this all start happening? Around March and April, the same time frame that we keep coming back to time and time again. Like everything else, we keep finding a massive shift a couple months ago, and this is a big one, maybe the biggest one yet. That means we're further confirming that this isn't just about a recession in 2024 or 2025. We're talking about short-run considerations that are mixing with longer-run complications. The 2010s were plagued by a lack of jobs, therefore a lack of income opportunities. What we're now seeing in the 2020s is they didn't fix that deficiency. They added another big one on top of it. So we've got the same lack of incomes and job opportunities as before, only now we're facing the prospect of recession, erasing quite a few of those we did manage to regain after 2020. But now we get to add the huge loss in purchasing power from the supply shock. So we have the two worst problems in economics that are now being combined into what lays ahead of us. Americans have lost all hope on incomes because, unlike economists who don't understand a thing about the economy, regular folks know that they lost a massive amount of ground in price changes that they are now, with unemployment rising, realizing they'll never get it back. That had been the hope of really 2023, that when disinflation began to show up, the economy would cool down and steady like Jay Powell and Janet Yellen had promised. The soft landing would have meant they were right, and we could start rebuilding the economy again and getting back that lost purchasing power. Instead, as the markets have been consistently pricing, recession means the path to clawing back purchasing power and rising incomes is all but gone. It's dead. So as unemployment has started to rise since March and April, shocking economists, American consumers saw that as powerful confirmation they've been screwed in the short run and again in the long run. That's what a recession really means, and most Americans understand the gist of it, even if they don't have PhDs. And as I'll keep pointing out, this is what the markets have been pricing. Treasury, both steepening, rates are going to go down. Forward rate curves, rates are going to go down a lot in the intermediate term, and swap curves, rates are going to go down and stay there. Exactly what American consumers are telling their surveyors about their income hopes. All of it fits together, only too nicely. Low interest rates over the long run mean nothing good. And given the context of the last couple years, that's really bad news, and Americans know it. Again, even if politicians and central bankers and economists don't, they do. This was never a vibe session. This was a transition back to the 2010s, only with now one more huge problem added on top: income growth. So what did the latest figures show? They came out from the University of Michigan, preliminary estimates on consumer confidence for the month of September 2024. The actual index improved. Again, there was a bit of a partisan split, but the confidence index moved up to 69 from 67.9, which is still very low. The current index, which is the one we've been focused on, that one had plunged since March in almost historic fashion. Well, it actually was pretty historic fashion. You almost never see a 20-point drop in just that short period of time without getting a recession. So there's a high degree of consumer confidence correlation with unemployment. This isn't about consumer prices necessarily. This is about the rising prospect of unemployment, and consumers have said they see that coming in the current situation. Even though in the month of September, the current index for the University of Michigan actually increased by 0.4 of a point. But it really wasn't much of a change, and it really wasn't any meaningful change, and it is still one of the lowest in the entire series that goes back over 4 decades. So this isn't about consumer prices. This is consumers saying we see a growing employment problem. And this is where we get into the income expectations. Now, the University of Michigan crosstabs, they give us a couple of questions on when they ask consumers about their expectations for incomes. And the first one, which is shocking in its own right, but not the big one. The first one they ask, what do you think is the percent chance that your income in the next 12 months will be higher than your income in the last 12 months? And 22% of people, a little bit over a fifth, said there's zero chance. There's no chance that their income over the next 12 months will be higher than the income of the last 12 months. Zero. Another 22% said there's only a 1 to 24% chance. So at best, We're talking about 44% of people who say less than a quarter chance that their incomes are going to be higher over the next year. We're talking a huge proportion of people. And more importantly, look at where this increase in negativity started to rise around March and April. So May, June, July, August, and into September. Summertime is the time for recession. But as bad as that one is, the real shocker here, the one that just sticks out on the chart, you just put it on the chart, and data goes back to 1998, so we're talking about 25 years of history. This one shows up as a shocking increase in pessimism, long-run pessimism. In this question, the University of Michigan asked, what do you think the chances are that your family income will increase by more than the rate of inflation in the next 5 years or so? So longer run potential for incomes to at least stay up with the rate of inflation. In a shocking amount, 36% of respondents said there is zero chance that incomes will be able to keep up with price changes. That's way more than a third. And another quarter of respondents, on top of the 36%, said that they're only giving themselves a 1 in 24% chance that real incomes will be higher over the next 5 years. And so you can see what's happening. As I keep saying, as I said in the introduction here, Americans realize that they lost a lot of purchasing power, and we're hoping that maybe just once Jay Powell would be right about the soft landing. If there was a soft landing, having lost a whole ton of purchasing power the last couple of years, if the economy steadied and there was a legitimate recovery, therefore, going forward, there would be a way to get back that lost purchasing power. So you can see why everything began to shift earlier this year. Because like the marketplace, Americans began to sense the labor market was not a soft landing. And what that meant was this potential pathway to regain lost purchasing power, the window was slamming shut. And so they told the University of Michigan surveyors they're more negative on income potential than they have ever been, and a huge spike in it because they understand the small e economics at play. And this is exactly what markets have been pricing. You got the yield curve that inverted way back in late 2022. Really, the inversion started in March of 2022. But the big inversion, not just in the U.S. Treasury, by the way, remember, European inversion too showed up in late 2022. What the market was saying is that the chances of the economy leveling off in a soft landing were dimming. And of course, that's when recession showed up in Europe and the U.S. economy started to at least experience a material slowdown. It happened earlier in 2022, but then it was basically confirmed in the marketplace. And then this probability, that rates are going to go low and stay there, really began to get hammered home last summer and last October when the economy inflected again. These things go together. The bond market rally. Rates are going to go down and stay there. And what that means for the economy is exactly what Americans are picking up. The greater the chances of going into a more than soft landing or worse than soft landing in 2024 means more than just recession risk in 2024 or 2025. So we have the lost purchasing power of the last couple of years on top of a background employment environment that looks like the 2010s with no job opportunities, no income opportunities. And when I talk about the 2010s, the numbers are just absolutely jump off the charts at you. Use real personal income excluding transfer payments, which is a key economic statistic that removes government transfers. So we're really talking about private economy, adjusted for prices. Though in the 2010s, that really didn't make much of a difference because price changes were relatively low, not for any good reasons. But real personal income excluding transfer receipts is, as of recently, is 4.3 trillion short of what the 2008 baseline would be. And that's because there's been another 1.3 trillion in lost potential just since the 2020 pandemic and the lockdowns and everything else. So as consumer prices surged over the last couple of years and incomes never really stayed up with it, what that meant was we were piling on another huge problem in the early 2020s on top of the 2010s. We lost purchasing power and never regained even a sliver of the lost job opportunities of the 2010s. And we see this in the participation problem. The labor force today is about 21 million people short of where it would be if the 2008 recession had actually been a recession. This is all silent depression stuff. So we took the silent depression of the 2010s and then added a supply shock on top, which just made everything long run worse. And as I mentioned in the video on Thursday, what we experienced in 2021 and 2022 was not a recovery, it was a price illusion. that looked like a recovery, but the markets told you that it wasn't. And increasingly, regular people in America and around the rest of the world could tell that it wasn't. The 2020s are shaping up to be somehow even more dismal than the 2010s. In terms of the job market numbers, even the establishment survey over the last several years, they talk about how robust the job market is, labor shortage and everything else. The establishment survey is 4.5 million jobs short of just the 2010s baseline. I'm not even talking about the pre-2008. There's 4.5 million jobs that should have happened that never did. That's a huge amount of lost income. And again, Americans were hoping that the labor shortage and the robust labor market everybody was talking about was a real thing, and that a robust labor market, when consumer prices and the economy finally steady, would lead to incomes that rose steadily and in a sustained fashion faster than consumer prices. They could get back that lost purchasing power. But as the labor market slows down too much in 2024, they know what that means. They're never going to get it back. The opportunities for jobs and income growth are disappearing with the economy. And it's even worse when you look at the household survey. The household survey is 8.2 million number of employed short of the 2010s base. Just the 2010s baseline, 8 million jobs or employment opportunities short. And full-time jobs, it's gotten even worse. We're talking about 9.6, almost 10 million full-time jobs short of just the pre-pandemic baseline. And those numbers have gotten materially worse over the last 6 months or so. And that's what Americans can feel. They knew they had fallen behind before, and now they can sense that as the recession develops, this is not just a short-run problem. This is a problem about what that means, about getting back to even close to even. Now, believe it or not, this is a discussion that went on in certain places before the 2020s ever started. They never talked about this in public. This is a discussion, an inside discussion among economists and policymakers, those like Larry Summers, who advanced the term secular stagnation to describe what we're talking here about, the silent depression. But more importantly, the question is, where is all of this coming from? What is actually the problem here? And in chart after chart that I keep showing, especially when we talk about the silent depression, you can see where this began. It began in 2008. Which was a specific type of economic event. It wasn't really an economic event, it was a monetary event, which the Federal Reserve will never admit, because that would mean the Federal Reserve was to blame for not helping out, for not stopping the monetary panic before it actually got started, or actually doing something about it and fixing the situation. Instead, they buried everyone under a pile of useless bank reserves under QEs and called it good enough. Well, what Larry Summers said in the middle 2010s, around 2015 and 2016, was, yeah, this is secular stagnation. There's something big wrong here. So what Summers said in an article in 2016 was, as surprising as the recent financial crisis, and it wasn't financial, it was a monetary crisis and recession, where he's talking about 2008, the behavior of the world's industrialized economies and financial markets during the recovery, which wasn't a recovery, has been even more so. Most observers expected unusually deep recession to be followed by an unusually rapid recovery. That's the basis of symmetry. That's what recession's supposed to be. If it goes down really quick, it should come back up just as quick, because a recession is nothing more than a temporary deviation from the trend. The trend doesn't break. But as Summers was pointing out here, and as I keep pointing out, silent depression, the trend broke specifically in 2008 during a monetary event. Yet even with the Federal Reserve's aggressive monetary policies, they're just interest rate policies or balance sheet policies, they're not monetary policies, the recovery has fallen short of predictions and has been far weaker than its predecessors. Had the American economy performed as the Congressional Budget Office forecast in August 2009, after this stimulus had been passed and the recovery had started, at least the green shoots, U.S. GDP today, again, remember this is 2016, would be about 1.3 trillion higher than it is. And that number has only grown through time. And what Summers said was this is nothing more than secular stagnation, as described by economist Alvin Hansen, wrongly trying to figure out what happened during the 1930s Great Depression. Alvin Hansen said it was a combination of land, innovation, and demographics. So what Summers really put forward was that there's too much savings, a savings glut, and not enough investment, which is correct. But then he doesn't identify the correct symptom. Why are we saving so much? Why is there too much savings and not enough productive investment? Because like what he says, Advanced economies see that people want to save more of their money, but they only want to save in the most safe and liquid fashion. Again, that keeps coming back over and over again. So they only want to save. They don't want to take risks and invest in productive ways. And that includes companies themselves, which he includes in this savings glut hypothesis, because we all know that there's something wrong with it there. Even though profits didn't really recover after the 2008 not recession either, they did at least rise. And where did companies put those rising profits, those lower growth profits? Not back into their businesses. They didn't expand productively. Instead, they bought back their shares. More financial saving than real economy risk taking. So Summers is right about that aspect. There is a savings glut, in that savings don't circulate through the economy in the way that we need them to. There is a lack of productive investment, but he never puts his finger on why that is. Why is there this preference for safety? Safety above everything. Where's this lack of risk taking coming from? In the end, it creates a false image of an economy. The stock market zooms because everybody wants a financial asset to perceive to be safe. I know we all think that stocks are risky, but stocks, especially these stock indexes, their performance is a function of a narrow slice of those indexes. Everybody owns the same shares and they continue to buy the same shares, and it becomes a self-fulfilling prophecy. It looks less risky, especially in contrast to the dim and moribund blaze of the real economy. We have a dearth of investment because there is no intermediation. And that's the key thing. Ben Bernanke said this in his 1983 paper, the famous paper that put him on the map, that what happened in the 1930s was that the banking system was broken by the monetary crisis. The monetary panic led to a destruction of intermediation capacity. And so everybody in the 1930s, Hansen was wrong, Ben Bernanke was right. Everything in the 1930s was about safety, 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 lack of risk-taking. Even John Maynard Keynes said the same thing. Where are the animal spirits? And we see the same thing happening in the 2010s because there's a lack of circulation for the same reasons. And all the signs and symptoms continue to come back to us. We see this in the participation problem in the labor market. That's a symptom of deflation. And deflation is an interruption in the free flow of money and credit through the economy. That's exactly what happened on August 9th of 2007 during the 2008, not subprime, not financial crisis, monetary panic. And the consequences were intermediation died. And when circulation stopped circulating the way we needed to, everybody preferred safety. Lack of investment, too much savings, too much safety. It's a monetary problem that led to the 2010s being the silent depression. What happened in 2021 and 2022 was not inflation, nor was a red-hot recovery in an economy. It was simply the fact that because supply was ultra-constrained, the government forcing stimulus through the economy meant prices created even bigger distortions than we had suffered in 2008, at least in terms of consumer prices, purchasing power. The inevitable result was a windfall to a whole bunch of companies, thank you very much, but they didn't reinvest in the economy because they didn't have any need to. Volume growth, as I mentioned in that previous video, was always way less than it looked like from the nominal perspective. So you had a bunch of harmful distortions that looked like a recovery when eventually we would have to pay the price for it. So not only do we have to go back to the 2010s baseline because we never really got out of that problem. Now we go back to the 2010s baseline, adding an enormous problem, additional problem on top, and that is the lost purchasing power of the last several years. That's in 2023 for a little while looked like maybe it would happen, looked like maybe there was a way to get back some of that purchasing power. If the economy did manage a soft landing, did steady itself in disinflation, maybe, just maybe, there'd be a way over time for income growth to rise faster than slowing down consumer prices, and we could claw back some of that purchasing power. But starting last October, again, bond rally, changes in the economy, and then a big inflection earlier in March and April. This year, another bond rally. Americans can sense, like the markets, the 2010s, we never fixed the 2010s, and now we added a huge problem on top of it we're not going to find our way out so easily. A lot of this comes back to that price illusion I keep talking about. And I talked about it in our video last week on Thursday in the context of Europe. That's the one I've got linked below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and Eurodollar University subscribers. And until next time, take care.